May of next year, the team at Argo Infrastructure, together with our portfolio manager, Cohen Steers, will be travelling to various capital cities around Australia as part of our National Investor Roadshow. It'll be our first National Investor Roadshow in more than 3 years, and we're very much looking forward to meeting face-to-face with our shareholders. Until then, I'm joined by Argo Infrastructure's Managing Director, Jason Beddow, to talk about the recent performance of the asset class and the opportunities offshore to invest in listed infrastructure. Jason, it's been an extraordinary year on broader global share markets. Overall, the markets ended sharply down, but global listed infrastructure was more resilient.
True. I mean, I guess as we stated with in the Australian market, utilities, which is a big part of the infrastructure universe globally, it's essential. So that part of the infrastructure universe did very well and posted positive returns. Equally, I guess there was other parts of infrastructure, which is always the way, and why we like to have an actively managed portfolio, didn't do so well. The higher multiple communication towers, anything leveraged to, I guess, travel, all sort of struggled in that environment. So net, yes, the infrastructure class did very well, but within that there was quite a lot of dispersion. And the other, I guess, part of that did do quite well was the transmission of oil, energy, the pipelines, just with what's happened with prices on the back of the conflict in Europe.
And can you talk a little bit about the impact of inflation on the asset class more broadly, given its relevance in the current market?
Certainly. I mean, a lot of infrastructure is quite well protected. Yes, a lot of those businesses carry debt, but a lot of it is termed out and it's hedged, which is quite good. But equally, they have inflators, CPI or inflation inflators in their business model. So as inflation rises, so does their revenue. And these are large fixed asset bases, so there's usually quite good leverage. There are some parts of infrastructure that don't have that flexibility, and equally, they'll have some challenges, but a lot of infrastructure, toll roads, utilities and others, they have almost a natural hedge.
And in Australia, we're obviously familiar with toll roads. We've got some exposure here, and until recently we had exposure to Sydney Airport or airports through Sydney Airport, which was recently delisted. Can you talk about the broader trend as far as ASX listed infrastructure companies go?
Well, look, there's not many left. I guess we've got Transurban, APA and a handful of smaller ones. Look, Australia really led the listed infrastructure, I guess, as an asset class. Governments in Australia were quick to seize on the opportunity to recycle, I guess, more mature assets to shareholders, both listed and unlisted, and redeploy that into new opportunities. And I think that's been a pretty successful model for Australia for, decades now. It's still relatively new offshore, and so I guess we take, airports being privatised as common. There's actually very few airports that are privatised globally. Like the US has none, Europe have a handful, and there's a few through Asia and elsewhere. So, they're quite unique to find these assets up for sale. Investors, and particularly as we look through, the big sovereign wealth funds, big pension funds, we have our own future fund. I mean, these vehicles have hundreds of billions of dollars and they're looking to invest them. So the long-term cash flows these industries provide, are very, very attractive for them.
So Australian listed infrastructure opportunities seem to be diminishing. So looking offshore obviously starts to become increasingly compelling. Can you tell us about some of the offshore global listed infrastructure opportunities?
Well, I just think it's the diversity. I mean, I think back in the infancy of when ALI listed, we talked then that, really you needed to get offshore to get exposure to other asset classes of infrastructure, whether it be renewable, communication towers, there's many. And equally the geographic diversity. And I think that just holds true now, and more so. So we think the opportunity set is better than it was. There's a lot of formation of new companies overseas. And equally, a lot of the more established ones, are potentially looking more attractive to be bid for new investors. So the universe is huge. We think the manager's doing a good job sort of scouring through it to provide ALI with what it needs to provide its shareholders, and I think it's an exciting sort of next period for infrastructure.
And looking ahead, what do you see for infrastructure on a global from a global perspective over the next 6-12 months?
Look, short term it is quite difficult. If interest rates ratchet up quickly, infrastructure can often lag There is a perception that any vehicle, the REITs are the same. Any vehicle that has a lot of debt on the balance sheet, clearly is going to have a high cost of funding, and that is often the case. But as I said, I think most infrastructure companies have quite a long tenure of debts hedged out over 10 plus years, and there's very little impact year on year. And will depend, I guess, on the economy. If the economy bounces back and is maybe not as bad as some of the more pessimistic outlooks, some of the more leveraged part of infrastructure should do well. Freight rails, passengers, so passenger rails, airports. If times get a little tough, there's belt tightening, consumers not spending, it's probably more your traditional utilities, essential services, water and the like that do better, because they're the last thing we turn off. So those business models are very robust.
Great. Thanks very much, Jason.